Good morning, everybody. Welcome to the Flow Show. I've got the ump, so see you in 2024. Have a good day. Morning, Kay. How you doing, mate?
He looks like Ueda looks like a zombie Father Christmas, right?
Yes.
Oh my God.
So that Day of the Dead
One of those
at
guys who's
Christmas.
very strange. Good morning, Ryan. Good morning, everybody.
Oh, I hope everyone's doing all right. Oh, what a day! What a day! Trading always throws up surprises. That's what makes this industry so interesting. Right, let's save all the good stuff to last. We'll save that Mr. Ueda till last, I think. So we'll kick off with our mates at the Bank of England. BOJ's Bailey was speaking after the release of the Financial Stability Report, the latest one. So these comments are with a financial stability slant, but we can put them towards current policy anyway. He says the full effects of higher rates are yet to hit the UK. And the rates are likely to need to remain around current levels. BOE's Breeden popping up as well, saying she's seeing signs or warning signs in private credit. Now, just in case you weren't aware what's going on, there's this, won't call it a fad, you might call it a fad. It's called private credit. And what that means is that there's non-financial firms loaning money. If I've been reading some of this stuff when it first came out, if there's ever a scheme that's likely to blow up and be the next financial crisis, this is likely to be it. So you have firms like venture capitalists and the like, even just normal businesses lending money to others. Why? Because rates are higher, and so therefore it's a good income stream. However, we know with all these wild plans, they are likely to go pop when something hits the fan. So this is something that is, I think, bubbling under the surface. It may become something, it may not, but this is the new MBS that did for the global financial crisis way back in the 2000s for the likes of Lehman. So BOE's Breeden is seeing warning signs in private credit. Kay, you see anything? Do you read up on this private credit stuff at all?
No. This is something that started to pop up recently. There's always been warnings about people needing to pay back or remortgage or stuff like that, and at much higher prices. But I haven't seen anything alarming yet. So this is probably a bit new, I'd say.
Yeah, I think we're at the early stages of it, and I think it just might, as I say, might be something just need to keep half an eye on.
Yeah, I mean,
for
it's
next
this.
year.
Yeah, the same is going on across the pond, right?
Yeah,
Credit spreads and those kind of things haven't blown out yet, but it's bubbling, right? Um, and if we, but we don't have something, at least not as huge as QE/QT was never as huge here. But there seems to be some early signs that QT is starting to eat very much into the reserves and across the pond as well. Something may be a little, I mean, starting to bubble, as you say. Yeah, something we definitely need to keep an eye on for what's going to happen in 2024, right?
yeah. There's one signal that you can all look out for to know when this is a bubble about to burst. That's if you ever get into a taxi cab and the cab asks you if you know about private credit, or when you drop your kids off from school or pick them up, the school mums ask you about private credit as well. So when the everyday man starts talking about it, you know the bubble's about to burst. That's usually a precursor. Anyway, let's move on from that. ECB's Casimir, the latest hawk to jump ship. Said that further rate hike is unlikely to be needed, but market bets are for Q1 rate cuts are science fiction. His actual tweet said that he agreed with what Schnabel said the other day, and that a further rate hike is unlikely. So, as I say, another one of the big hawks turn into neutral, not going dovish, but turn into neutral. ECB's Vilroy says the issue of a possible rate cut could be raised in 2024, but not right now. He's one of the doves. Says there is a slowdown, but no recession. This is speaking with his beret on rather than ECB hat. It says disinflation is happening quicker than expected, and there's no plans to adjust France's 0.9% economic growth forecast for 2024. Over in some of the data we've had, let's go down. We've had some trade data out of Australia. Trade balance improving, not as much as expected. Exports showing a bit of positivity, up 0.4%, but imports going the other way. That's not such a bad thing. Countries always want to export more than they're importing, so that's working out well there. China as well had some trade balance data as well. Again, another improvement, and well, again, positive on the exports, not as positive on the imports. As you can see there, the actual percentage numbers there. So again, moving in the right direction, a bit of an improvement there as well. Coming down to some of the other data, not a whole lot much out. German industrial production coming in softer than expected. No real shock there, considering the factory orders and the likes that we've seen in other data from those guys. Coming down, we've already got trade balance from France as well. Nothing much to write home about. A little bit worse in the deficit, but not as much as last month. And OK is going to talk about those Swiss foreign reserves. Some news to come from that. Italy's industrial production as well, not as soft as expected, but still negative numbers there from those guys. On the ECB front, Deutsche Bank, they're all out with their Tipex pens. They now see an ECB cut in April versus their prior call of June. So the speeding up in rate cut expectations continues, a snowball gathering pace and more snow as it goes. Just coming back to the US yesterday and Canada obviously as well. We had ADP coming out a little bit of a miss, 103k versus 130k expected. The prior 113k got revised down to 106k. No real worries about that. A 27k miss isn't going to ruffle any feathers. It's still a positive number. These ADPs have been coming in a bit on the low side, towards the low 100s, rather than any strong, but no real big shocks coming from that. So the market pretty much brushed over it. Bank of Canada, they kept rates unchanged as expected at 5% and played the balancing act, saying that they're still concerned about the inflation outlook, so are ready to hike again. But recent jobs data and Q4 indicators suggest the Canadian economy is no longer in excess demand. So, as I say, a bit of a balance between inflation risks and the economy softening. As expected, it was a bit of a non-event. I think dollar CAD moved about 3 pips over that. We do have both Macklem and Gravel speaking today. I think there's a Bank of Canada AGM or something. So we've got both those folks speaking today. I'll just show you when. There's a bit of a discrepancy over the times. One calendar, this one has Gravel speaking at 17:30. Another calendar has him speaking at 17:50. And there's Macklem speaking at 17:40. But given how much of a nothing burger the BOC was, I'm not sure we're going to get anything stronger for those. I certainly won't be around for it. So you're all more than welcome to it. Right, let's get to the man of the moment, Mr. Ueda, who decided he was going to set out a bit more of a policy exit path for us all. Now, he was speaking, I think, in a parliament event, and then he went and spoke to Kishida as well. He started off in his same usual tone. He said the economy has recovered moderately and likely to continue. but still sees very high uncertainties over growth and prices. The inflation trend remains below 2%, so we need to keep up easing. Still not seeing certainty of achieving the inflation goal, and added that the job may become more challenging after the year end. So nothing in those early comments, but then he started to talk about an exit. He said the BOJ has not made a decision on which interest rate to target once we end negative interest rate policy. And the options include raising the rates applied to financial institutions' reserves at the BOJ, or revert to policy targeting overnight call rates. He said it doesn't have any specific idea in mind on how much we will raise rates once we end negative rate policy. That alone was a hawkish comment, because a lot of the market expecting they'll just go from negative to zero. He's tipping the nod that they may not do that. They may carry on going or even raise higher. He did say he doesn't. He may not be at a stage to emphasise an exit, and that it's important for wages to keep rising. Then he made it a bit clearer what his thoughts were as to when inflation is more stable. He said achieving the 2% trend inflation can be defined as a state where the economy, lacking any new shocks, can see inflation sustained around 2% and wage growth somewhat above that level. So pretty much he's put in greater detail the exit path and the changes that they may make. Now, this has come obviously at a moment, as we've been saying, where everything to do with the Bank of Japan has moved out of the market's gaze. Everyone's looking towards these wage hikes, not expecting anything for the BOJ meeting on the 19th. And everyone was looking at everything else, and dollar yen and yen trades in general were not doing an awful lot. So this has caught the market on the hop. It's seen us doing a big repricing now of Bank of Japan expectations. It's ramped up expectations for the December meeting as well now. I don't think we're going to get anything at this December meeting. We know that everything is to do with 2024. But that's not going to stop the market getting expectant about it. So here we are, dollar yen, taking a bath. It's gone through, carved through all the levels. It's carved through the big 145 level, which is a big level historically. This goes back to the 80s and 90s. I won't show you on this chart, but it was a big level on the way up when we first started coming up in the 2022 rally. Then it was support, and then it broke, and then it was resistance again in the 2023 rally, and you get the picture. We stopped there for about 5 minutes this morning, a bit longer than that, I think about an hour, before finally breaking it. So this is a big shift from the Bank of Japan K. I think a lot of us are kicking ourselves. I mean, I've been itching to get short, but wanted to hold off, maybe get over the Fed, a rally over the Fed and the BOJ. But have we missed the boat?
Good question. Yesterday and the day before, I was saying it's a bit strange. The market didn't react at all, because I thought Himino was already a bit hawkish. That study from the Bank of Japan that came out on Monday or Tuesday was also a bit of a I wouldn't say a red flag, but raising my antenna. And I was actually waiting for 148, as I also said on the face show yesterday, for to see if there was anything to do. And then we wake up this morning and it's 200 points lower. So that was a bit of a wake up call. Again, my base case is also for no change on the 19th, that we're still in the slow pace, but definitely some short yen positions have been woken up and shaken out on those comments, because this is yet another step. And as we've been saying, it's going to go in steps, going to go very gradual. This is yet another step. Now, whether we're completely done with yen weakness, I'm not sure. But the thing is now that in line with what's been going on in changes for expectations for all the major central banks. Now, some Japanese analysts are starting to put a 45% weight in even in the December meeting. It's 45%, still below 50, but and you know how I don't like to talk about those percentages. But anyway, they're putting a certain weight even on this December meeting being live. Again, base case not yet, but and before any meeting now, we are going to see this kind of speculation or more people getting out of long-term positions. You know, I mean, if you look at it really in the broader sense of the moves, going back to even when it all started 2 years ago, we are still only at 23.6% or not even 38% retracements, even from the 127 in the early stages of the when Ueda came on board, and after the last meeting of Kuroda, we're turning around that 38% now, around around 144 or so, 44.60. So it's still in retracement territory if you look at it technically, but obviously something is changing, and as we've already been saying, the rest of the world is not going to accelerate anymore, but Japan is possibly going out and likely going out of their negative interest rate policy, and him saying that they won't stop at the 0 point should not, in theory, be too much of news. I mean, if you start to normalize, you're not going to stop at 0, right?
Yeah.
But we can't deny the fact that there still must be a lot of long-term short yen positions who start to feel the pinch. You know, the pinch is a big word, but they will say, like, why would I stay short yen if next year there is a possibility that I may find levels, I don't know, 10% better to step in again. So they're moving out of positions, and the positions are large because it is your biggest carry trade, right?
Yeah.
Still in the markets. So that's that's really another leg, as we've seen some other legs, you know, in the past months. Whenever there is a hint, the market goes all bananas, and then we see. Yeah, I mean, that's the only thing I can say right now. Has it completely turned, and is dollar yen going down to 142 or even below 140? It's just too early to call, I reckon. If the dollar yields and euro yields continue to plunge, yeah, probably. If it all stands here, then I still think there is a possibility that we are getting into the 19. They don't give too much, and we're trading back around 148, just to name dollar yen, you know. But there is definitely something changed on and if you look at it on the technicals, broken. Like, for instance, euro yen is in breakdown territory, clearly breakdown territory. So that one is now breaking down. Of course, there's going to be levels, but it is breaking down. This is a sharp move from those 160s. You know, we're already 8 big figures lower there as well.
Yeah, and I think I wouldn't say it's an overreaction. It's at the moment it's the path of least resistance. You know, these yen pairs were already coming down before Ueda spoke. You know, we know because the market getting dovish on the Fed, so dollar yen's naturally getting it. Then the market switched to getting dovish everyone else, so all the other yen crosses are getting it. So now the BOJ throwing out a hawkish take bomb. It's the path of least resistance at the moment. So that's why it's been pretty easy carving through the levels, because anyone who, like Kay was saying, who was short yen up here was thinking, okay, right, we've had some moves over the other central banks. Okay, now the Bank of Japan's throwing their hat in it. You know, and that it creates a snowball effect of people then getting out of trades. But like Kay says, does it mean we're going all the way down, 140s in euro yen, to be decided? But we should expect that these rallies, any rallies in yen pairs, are going to get hit pretty significantly. I think seeing 148 in dollar yen might be a bit of a pipe dream, and I'll bite your hand off for it. But you never know. You never know. So I might be forced to start chasing this one. But then you've also got to remember, it's not worth trying to short at these levels after this move, because you get the BOJ on the 19th and he says, yeah, but we're still easing. We're not sure. It's all up in the air. It's all still questionable. And then the market goes and rally in yen pairs again. So, yeah, I wouldn't sell it down here. Need more evidence. I was just, my trade plan was to hopefully see dollar yen rising over the Fed next week, and then maybe an unchanged Bank of Japan or the week after. But yeah, that plan might have got out the window.
My instrument of preference right now, but that's because I have a bit of a bias on the euro, would be rather euro yen, and leave the dollar out of it. You never know. Yeah. Definitely there's going to be rally sellers in everything right now versus yen, right?
Yeah, exactly. So yeah, it could be a case of pick your poison on this one. But yeah, there's always a trade, even if we miss out the first few percent. If this is a big shift, then there might be plenty of pips still to be made. I just like to get in nice and early, and for once I didn't scratch my itch. But anyway, that's that. Kay, you got any other news items? Because it's pretty bland. Oh, you want to talk about this the Swiss numbers, don't you?
Yeah, I think that's. I'm going to keep it to that. The rest is all a bit of opinion pieces and stuff. The only thing. Now you're on the calendar for those trading mix. We are going to have the CPI numbers out. You don't have the mix on your calendar, right? And then we were going to have the CPI numbers out in a good hour. Okay, keep an eye on that, because there is a possibility that those numbers are continuing to come off a little bit. As we know, also the Banxico went into neutral. You don't have the CPI on there? Oh,
Yeah.
anyway,
Yeah,
Banxico went into neutral, and if those numbers are continuing to come down, it's expected to be a bit sticky. But I wouldn't know really why there would be a more sticky number. But anyway, keep an eye on that. For if it remains sticky, I think stuff like Euromex, for instance, can get another little knock on the head. I'm going to watch it quite carefully, that one. If it turns lower again, then we may see a bit of a rally unfold in the dollar mix also. There is something that I'm going to keep a close eye on, apart from all the other data, of course. Yeah. But no, in the news, well, there's two things in those reserves. One that I found a bit strange, and those Chinese reserves coming out higher than the prior ones, which is extremely counterintuitive, because we've seen over the past month and months that they instructed the Chinese local banks, their submarines, to go and sell dollar China. It's a bit bizarre. I mean, perhaps those numbers got stuck in the printer or in the local bank's PCs, but I found it a little bit bizarre that those Chinese FX reserves were actually higher than prior.
Yeah.
It's in dollars. That may mean it's just a reval, with the Chinese one having strengthened. Okay.
Yeah.
Do you
want me to put up the Swiss reserves chart for Magix, or you want to take it?
I have it. So I can share it.
Yeah. Okay. Let me palm it off onto you quickly then. Maybe we'll change it around. You can do your little look around, and then I'll have a look a little.
Yeah, sure. And I'll comment on Ali's gold position as well.
Cool.
So this this is the report of the Swiss reserve. So they've gone down another 16 billion Swiss franc, which is absolutely crazy in our opinion.
What's
We
it
are
doing,
now
mate?
at levels back to 2016. We were already,
Hey,
yeah,
it's got a black screen. I don't know if
I've got a
that's
black
just me.
screen.
Yeah. It says
Okay,
I'm viewing the screen, but it's black. I don't know if that's the same for everyone else.
no. So
Oh, you can see
Kevin
it. Just
says
to
they
me
can
then.
see the chart.
Oh well. Just I'm in the blind. Go on. I know what it is
Okay,
anyway.
yeah, yeah. So we were already commenting on this when we came into pre-COVID reserves and thinking that the S&P and the S&P with CPI starting to slowly coming back down within their target zone, they may stop sooner or later. But they have surprised us month after month, and now we are trading at 2016 levels. Which is compared to any other central bank really, really hard. I mean, to comprehend as well. We know that Jordan and friends were saying that a strong Swiss is combating inflation as well. But I mean, this is really getting to levels where we are starting to scratch our heads. I was saying, like, I mean, as Jordan really made his choice as saying, like, for as long as I see reserves in the books, I want to sell them. We don't know, but this is starting to look a bit crazy in my opinion. And we do have SNB next week, and I mean, logically, I would expect him to talk about these things, about the strength in the Swiss franc, about the Swiss franc. And as I was saying already, I'm really looking at them or waiting for the moment that he says that they are happy with where they are. Not that those reserves are going to go massively back up, but at least stop it, right? I mean, this is really a huge move. You see, there's 300 billion Swiss franc worth here. Right? That's a lot. Um, so they've really been forcing the market not to sell any Swiss franc by doing this. And again, next week, SMB, I think this is going to be important if he starts to comment on that, because in any sane brain, we would think that this is enough. They shouldn't be really going much lower. And this build-up here is when they up to here is when they were defending the 120 in Euro Swiss, and then they've been building because they were still buying Euro Swiss at all the way down in Euro Swiss, and this is then the COVID. But we are now getting back to levels where they were actually defending the Euro Swiss and the dollar Swiss are the other way around. So we personally think that this is going to stop sooner now rather than later. And if we get that, then I expect the Swiss franc to finally start to turn around. Okay, but again, we had a bit of a surprise there when those November FX reserves data came out, and seeing that SMB is still buying Swiss franc. Right. I'm going to have a quick look at the currencies, and I'm going first of all to go to Ali. Ali, you're a short gold. Right. First of all, I think the support here is big enough. So where you're already taking profit around 2025. Okay. I mean that makes sense. Your stop also, it's a very, very short-term position, because $3-4 in gold is really quickly done. But your sorry, your short-term makes a bit of sense, because I was looking at this morning, and if you look at the 4-hour cloud and then looking left, it also has played a role in the past. This 4-hour cloud, whether we get closes inside or not, and it's coming in around 2034.5 now. These 4 hours, it stays there until this afternoon. Okay, I think if we start to move above and hold, then it's not too much of a reason to be short gold anymore. Just to be clear. I'm actually trading the other side of this support here. Let me take away the cloud for clarity. I think there's really decent support, as I've already been mentioning, around corridor 310 on the on gold. And for as long as that holds after this spike, then I think there is perhaps a good enough reason for metals to push a little higher. Okay, so I'm rather looking at the other side. But if you are really in a very short term one, yeah, why not? 2025 is always possible at any time. On yeah, euro sterling, I think we are getting into more neutral territory, but this could be what they call a bit flagging, and we've already spoken about this 86 figure 10 level, figure 15. For as long as we're below, it does look like this is oriented a bit to the downside still. So I wouldn't disagree with your position. Personally, I don't have it. I think we're consolidating here a little bit. Do we have stuff out from the Bank of England, or are we done now until the meeting, Ryan?
What you mean, speakers or
Speakers or important data?
I think we're done on the speaking front.
Yeah,
As I say, that stuff yesterday was financial stability, so not monetary policy type
yeah.
stuff. The only thing we got is wages data from the jobs numbers on the 12th, I believe.
Okay. Okay, so nothing before next week, really. I think you're going to trade perhaps more euro than sterling until then. It's just my feeling, you know. If you look at it really short term, yeah, it's within this whatever people want to call this flag pennant, whatever. But it's still oriented to the downside. There's no doubt about it. Okay. Your stop is just above that 86.10. Yeah. Okay. I mean that makes sense. 85.42. Yeah, that's around here. Why not? I mean, yeah, as I said, I'm relatively neutral, but it does look like sterling is still that tad stronger than the euro right now. So won't disagree with it. Deregi, sterling, yen. It's like most of those yen pairs, right? They've all broken down from what we saw before. There's whoops. What is all that about? Why is my chart empty?
Yeah, I'm just trying to flick around my trading view, and it's all locking up.
Oh, really? Yeah. Oh, I see it. Wow, this is not going to make things easier. I can't even update it. I can't even change.
Neither me. I'm trying to go through different pairs, and it's not showing up.
Here. We're back. We're back.
Okay.
But it takes an awful lot of time. Look at sterling yen where we are, Deregi. We are right on the daily cloud. Okay, it's an extremely thin one, so that means that it could really crash through relatively quickly. It's not something like if you look at a bigger cloud here, where you're going to have a lot of work to be done inside. This is really a very thin one, so it could indeed crash through. But then look at what's waiting below, and that is going to be just around 180. Okay. I'd say in the short run, look at what's happening back up. If we start to get back up, you look those daily moving averages, they are right around those prior highs, prior lows, and it's all happening in the 84, 83, 60, 84 zone, okay? That is where the top side you need to watch for the what's happening to the top side now. I would say the Reggie, okay, but most of it, I mean, it's just going to depend on yen, right? It's nothing. All those pairs now that we are looking at is just all yen. The yen is moving, yeah. Euro yen has broken down, and Euro yen has also broken down. Here we go again. It's really oh no.
Yeah, it's on a go slow. It's on a go slow.
Yeah, it's very slow. But okay, Euro yen has broken down. Sorry. I was already watching that 158 crash through. The daily cloud is also around here as well. And it crashed through it as well. So if anything, and I'm still a bit bearish euro. If anything, this euro yen is probably, if you want to continue to trade yen on the long side, if you want to continue to trade yen on the long side, okay, this is probably a decent candidate to find rally sellers anywhere. Yeah, and it's going to be tough because my trading view is not updating. Yeah, I don't recall the exact levels of the daily cloud, but we are through as well. So anywhere around the bottom side of the cloud or the top side of the cloud, it hangs around here somewhere, I think we're going to find the sellers. But your major, so we already have like 157s, but I think there's going to be something that is going to have to be monitored around 158.5. It's really difficult when stuff is not coming up as it
Yeah,
should.
Kay, I've just made you host because I still can't see your screen and things are going a
Oh,
bit wonky this end. So I've made you host. I'm just going to back out and come back in again. Okay.
yeah, sure. Oh, there we go. So here's your cloud on the euro yen finally. So that also happens in the 157 and a halves, mid 157s, the bottom of the cloud, and the top end of the cloud lines around that horizontal resistance, okay? So this is really definitely going to be a level that is going to be scrutinized also by our Japanese friends. Oh yeah, you're short the Reggie. Okay, makes sense. A lot of people, are a bit long yen and having a good day today. Well done, all of you. I'm just gonna go quickly back. Yeah, it's the same in all the yen crosses, right? Aussie yen broken down, and the Kiwi yen is one, of course, where we need to keep an eye on because we've been breaking and trying to really see what happens around this very long-term trend line in the Kiwi and around this 89, 90 zone, and we are now getting back down. So keep an eye on what's happening anywhere between 89 and a half and 90 on the Kiwi yen. Okay, if that starts to break back higher again, perhaps the story on the yen was again a short-term story, as we have already seen a number of times, and we move back up. Start to retest and get down, that means that the longer termers in yen have likely made a decision now saying that, okay, this is now good enough for us to go long yen for longer. Right. I just want to go quickly back onto the euro dollar. So the euro dollar, as I was showing this zone here, 107, sorry, 35 to 107.70, 65.70. We are hanging around it, and I'm not sure what's going to happen with the US data coming up, yeah, but we have a big one tomorrow, NFP. And as I said, this is my reassessment zone. We haven't really not broken down. We haven't really tested the 107.35. It's possible, but as people in our room know, I've been long from here, 109.80, and ran it short. And I've decided to just move out of it, out of precaution right now, and then I will see over the data whether it's warranted to re-enter a short. I'm still mildly bearish on euro overall. So if we start to see US data coming in perhaps a little better than expected, perhaps those supports here can hold on the US 10s. There's still quite a bit going on until 4% here. But if those supports starts to hold, perhaps then the euro dollar is in for a break. And if you look at my favorite monitor, we are living on the edge. We are actually trying to break down through the box, but we still have to look at what's happening around 205, 206 BPs and around this trend line here. So that's one of the other reasons, if because we are in support here on the on the differentials, short-term differentials between euro and the dollar. It's hanging low. That is preventing your euro dollar to start to rise. But if the US data is coming bad, then this is going to get back into the box and perhaps going back into the middle of the box, and euro can recover. This is one that I'm going to probably keep a very close eye on into tomorrow's NFPs. And then last one, and then I give it back. Ryan, are you back up and running? Is it all okay now?
Yeah, I can see your screen now. Everything's running fine, and
Good.
trading views running fine. Yeah.
Yeah, good. Last one that I'm going to keep an eye on, as I was saying, like we have those Mexican CPI data coming out in an hour, and this has been doing lower highs here. It's in a big traffic zone here that we are trading. Okay, if there is nothing really spectacular coming out of the CPI data, I do expect the rallies again to find a bit of sellers. It will of course also depend on what risk is doing elsewhere, but this one is still on my radar for eventually a test back into the 1850s, and who knows, perhaps lower. If we start to get back down, then we get back into this channel, and somewhere is still in my mind that this is really possible to happen. But for that, we have to see those Mexican data keep up. And that's it for me, Ryan. I'm handing it over back to you, because perhaps you want to share a couple of other things.
Yeah, I'll just have a look at a couple of things. Thanks, mate. I don't know if you got. Did you get Aussie dollar?
No, I'm pretty pissed off with the Aussie, so no, I didn't.
Yeah, there's lots to be pissed off about today, mate. Right, can you see my screen okay, first and foremost?
Yeah, all good.
Yeah, just back to Ali. I saw you took a bit of partials in the 85.50s. That's sensible. If this was me, if you get a break of 85.50 as been pointing out on the last couple of shows, we're probably going to head a lot lower. So you might want to consider that with your final TP. Now you've taken some off, maybe think about if you do break this 50 area, you might get a bit more than your final TP. So give that a little bit of a consideration. You know, as you know, I like to push a trade that's going the right way as far as possible. But you're trading, Ali, so you know what to do best for yourself, mate. But I just thought I'd throw you that. Yeah, Aussie dollar.
Can I ask a question, Ali? Are you trading anything else than spot FX? Or what is that level that you got in euro sterling there? Are you trading futures, or are you trading something bizarre? Just a question that I have on the level where you took profit. Yeah, go on.
Yeah, I'll click on. Yeah, it's trading Forex only.
Well, that's bizarre, because my low is 55 on the euro sterling today.
Oh, we're playing guess the lower. Wait, let me check mine. 54.1. So yeah, there or thereabouts. Anyway, yeah, Aussie dollar. We've all been speaking about this level down here, 65, 25, 20. Bit of a zone from 40. Got the fib in there as well. I had my fishing rod out yesterday, but I packed it away last night. I wasn't going to leave any orders in. It was trading just under 50 at the time last night, and yeah, I don't. These sort of scalp trades off the levels, I don't like to leave orders in overnight when I'm not in control of it. So I thought I'd see what happens in the morning. But it's hit the level. It went through the 40s. It's hit the fib, ducked under, hit the 25, and then boom, it's bounced from there. So I'm going to be careful if we get another quick test down here. This was the move I was looking for, and a lot of people in our room were looking for as well. It's that first initial test of a big level and a decent reaction, 30, 40, 50 odd pips off of that. If we come down again, I'm going to be a bit more cautious, because I'll be worried, why are we coming back down to this level so quickly? We're still in a downtrend. We're still making lower lows. We're still making lower highs. So another move back down towards this level, I won't be so keen. I'm never one to think, oh, that one worked last time, it's going to do exactly the same again. That was the move I was after. This time it might be something completely different. But for now, this area, and it is a solid area, is holding up. It's done what it needed to do. But as I said, the rallies are looking a bit, or the bounces are looking a bit weak, and they're getting hit pretty quickly. So just keep an eye on that one as we go on. Only other thing is the rest of the data today. Kay's watching the Mexican CPI stuff, PPI stuff. I'm going to keep an eye on Challenger layoffs, US Challenger layoffs. We've been mentioning that there's been an uptick in headlines about job losses hither and thither. So this will be a report where that might be showing. Where was it? Let's get it up quickly. There we go. So this is a number. It's not a huge number. I'm not saying the market really gets its teeth into unless there's some big numbers coming up. But this highlights firms' intention to cut. So when you hear those layoff headlines, Spotify is looking to lay off 1,500 people. This is the report that it should appear in. Doesn't mean all that 1,500 are going to be laid off and out of work. It just means their intention to cut jobs. So keep an eye on that one. And then obviously jobless claims. This will have no bearing on the NFP because it's last week's data. It's not during the survey period when the NFP was coming. But if we get a move higher in those continued claims, it will get the market a bit more worried about the job situation like it did for the JOLTS. And on that note, we shall call it a day there. You will be getting a special guest tomorrow, the Wizard of Waves. Our man, Gregor Horvat from ForexAnalytix is going to come on for some updates because I'm off. I'm doing my last minute Christmas shopping and taking the wife to lunch. So while the kids are in school, we're going to be running around. So I will leave you in both their Gregor's and Kay's capable hands. Have a great day, everybody. Thank you very much, Kay, for all the input today, and we shall see you all tomorrow.
Cheers, guys.
I'll be back on Monday, Ali. Don't worry. I won't be gone long.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.